You hear the term interest rate, and you probably just picture a percentage, right? But what if I told you it's really more like a price tag? It's the price you pay to borrow money. So let's break down what's actually on that price tag.
Yeah, so what are you actually paying for when you take out a loan? It turns out that single percentage, well, it's hiding a bunch of different fees, and each one tells a very specific story about risk. We're going to unpack that price tag piece by piece.
All right, first up, we've got the most intuitive part of the price. I like to call it the will you pay me back fee. Because, it really all comes down to one simple question a lender has for any borrower.
Okay, so the official term for this is the default risk premium, or DRP for short. It's basically the extra interest a lender charges just because there's a chance, however small, that the borrower just won't be able to pay back the loan, that they'll default.
To really get this, let's imagine you're lending money to two different students, okay? You've got student A, who has a steady job, perfect repayment history, the whole 9 yards. And then there's student B, unemployed, maybe a little forgetful. Now, who are you going to charge more interest? Student B, right? Exactly. That extra amount you charge student B, that is the default risk premium. So yeah, it really just boils down to this. The more risk a lender sees, the higher that fee is going to be. It's a direct reflection of how confident they are, or maybe how not confident they are, that they're getting their money back. Okay, let's move on to the next fee in our little price breakdown. Now this one's different. It's not about the borrower at all. It's about the money itself. I call this the lost buying power fee, and it's all about inflation. So this is called the inflation premium, or IP, and it's the extra interest a lender charges to protect themselves from a simple fact. The money you have today is worth more than the same amount of money will be in the future, all thanks to rising prices. I mean, think about it this way. Let's say you lend someone $100, and over the year, inflation is running at 3%. If you get back just that $100, you've actually lost money. Your $100 now buys you less coffee, less gas, less of everything. Your purchasing power has gone down. So the inflation premium is basically the lender's way of hitting a reset button. They charge that little bit extra just to make sure the money they get back has the same real value, the same buying power as the money they lent out in the first place. Okay, next up, we've got a duo of premiums. Now, these are a little more advanced, but stick with me. They're both about the risks that pop up over time and, how easily you can get your hands on your cash. First up is the Liquidity Premium. I love this one. I call it the "can I sell this quickly" fee. It's the extra interest you get on investments that are, kind of a pain to turn back into cold, hard cash without taking a loss. Think of it like this. You can sell a share of Apple stock in, 2 seconds at its market price. That's highly liquid. But what about trying to sell a piece of antique furniture? You might have to wait for months to find the right buyer, or maybe slash the price just to get rid of it quickly. That's illiquid. So lenders demand a higher return, a premium, to make up for the risk of having their money tied up in something that's hard to sell. And its partner in crime here is the maturity premium, or as I call it, the longer time, more risk fee. This one's pretty simple. It's the extra interest charged on longer term debt. Think a 30-year bond versus, say, a 6-month one. So why is a longer loan riskier? Well, there are two big reasons. First, you've got interest rate risk. Imagine you're locked into a long-term loan at a low rate, and then market rates suddenly shoot up. Ouch! Your investment is suddenly way less valuable. And second, it's just pure uncertainty. I mean, so much more can go wrong over 30 years than in just 6 months, right? The maturity premium is the lender's payment for taking on all that long-term unknown. All right, we've unboxed all the hidden fees. We've laid them all out on the table. Now it's time to put it all together and see what the final bill actually looks like. It turns out you build an interest rate just like this, step by step. You start with a base level. That's the real risk-free rate. You can think of it as the rate for the safest possible loan out there with zero inflation. Then you just start stacking on all those risk fees we just talked about. You add the inflation premium, then the default risk premium, the liquidity premium, and so on.
And voila, that gives us our grand finale formula. The interest rate you actually see is just the sum of that base rate plus all those individual premiums for inflation, for default, for liquidity, and for maturity risk. That is the total price tag.
So, just to make this super concrete, if that base risk-free rate is, let's say, 2%, and all those different risk premiums we talked about add up to another 3%, then the final interest rate you pay is 5%. See? It's as simple as that. So, what's the big takeaway here? What does understanding this whole formula actually unlock for you? Why does this matter? Here's the main thing I want you to walk away with. Every single interest rate tells a story. It's not just some random number pulled out of thin air. No way. It's a really detailed, calculated assessment of all the different kinds of risk wrapped up in that specific loan. And that kind of leaves us with a final thought, doesn't it? Now that you can read the price tag, now that you can see all those hidden fees, which one of these premiums do you think is the biggest driver of the interest rates we're seeing in the news today? Is it inflation, default risk, something else? It's definitely something to think about.